Douglas Lodmell, welcome to the Capital Raisers Show. I'm super excited to talk to you. You are actually, believe it or not, probably your office is maybe 2 miles from where I live. I live on Central
Oh,
Camelback, and you're right here on 16th Street, I believe, and
yeah,
Terry
yeah,
Lynn,
yeah. We're very close. I should
Osborne
have
Road.
driven over. Huh?
Yeah, I could have done it in person or gone to a
Yeah.
bar and done a live something. Anyways, I'm really excited to talk to you. I told you before the show that I'm all about multifamily syndication. My audience is all about raising capital and learning this business. If they haven't already, a lot of people get some entertainment value from the show. But when it comes to your business, you're in the asset protection business as a lawyer, and there's some intermingling here that's going on between the multifamily syndication model and what you do. Welcome to the Capital Raiser Show. Thanks for
Thanks
coming
for
on, Douglas.
happy to be here.
Awesome. Tell us a little bit about what you see in regards to multifamily syndication and how your services can benefit a multifamily syndicator. You have some really big clients that are syndicators.
Yeah, I do. I have lots because this is an area that's really kind of hit its stride in the last 5-10 years. So there's a lot of people doing this. It's a great area. It's just ripe with opportunity. So if you're in it, congratulations. If you're thinking about getting in it, it's really there is a lot of opportunity if done right. So what I do is I look at the personal side of things and I say, okay, let's look at your personal situation, look at your assets, and say, how can we set up a legal structure to make sure that if anything goes sideways, whether you're a general partner, whether you're just participating in deals, whatever it is, if legally anything goes sideways, we've structured your assets in such a way that they're very, very difficult, if not basically impossible to reach. From a litigation standpoint, this really reduces you as a target for litigation. This is particularly applicable, of course, if you are syndicating real estate, because you are taking on some risk. People are giving you their money. That immediately puts you in the target zone for the risk. So setting up and understanding what legal structures are available to get this done right is really critical. And that's what I would encourage anyone who's thinking about doing this, is to call someone like me and say, okay, how do I set this up so that as I grow, I'm creating a legal barrier and I'm protecting what I'm building.
Yeah, I interviewed a gentleman named Bruce Peterson who wrote a book explaining the challenges of being a multifamily syndicator. And he
Yeah,
said, hey, if you do this long enough, you're going to get sued,
for sure.
essentially, depending. So has that been your experience? Have you seen syndicators being sued? Can you talk to us a little bit about that, what you've seen?
Yeah, yeah. I mean, lawsuits today are very easy to start. They're very difficult to stop. I mean, we had a legal system that was really built. It was really structured by the founding fathers to dissuade lawsuits. Today, that all the infrastructure that they put in place, the prohibition against contingency fees and the very strict civil procedure requirements to understand what you're even suing for, even the ethical requirements that lawyers were prohibited from pursuing frivolous claims, that's all been dismantled. The plaintiff's attorneys control the game now. So it's its own business model, suing people. If you live in Phoenix, every billboard is an attorney, the discount lawyer, the wolf, the guardian, the eagle, whatever. And it's a massive industry. So getting into lawsuits is not difficult. All you really need is a bad outcome. And doctors have learned this. There's no guaranteed procedure, but if you have a bad outcome, you're pretty much sure to be sued. And certainly since the financial crisis, anyone taking anyone's money has learned this. So you can have informed consent, you can have a PPM, private placement memorandum, you can do all the documentation and the disclaimers, but if you take someone's money and it doesn't work out the way they thought it was going to work out, they can sue you. And there's really no way you can just say, hey, here's their waiver. That doesn't really hold much weight anymore. They can keep that lawsuit going for a long time. So what we found is that the best way to discourage lawsuits is to remove the incentive. And the incentive is money. So if you can put your money in a way, structure it in a way where legally it's very, very difficult to reach, we can use that to either dissuade a lawsuit from being started, or if one does get started, to get it settled or dropped quickly. But to answer your question, yeah, I mean, most of my syndicators who've been in the business for more than 10 years, at some point have had to deal with lawsuits.
That sounds tough. Now, if people are after, typically when they sue somebody, money, that can be avoided. But what if they want to take your property from you? Is that something that you can protect as well?
Well, yeah. I mean, property is another asset. So money is an asset, property is an asset. So again, when you're structuring your deals, you structure them in such a way that all the assets are covered by the asset protection structure, including the properties. So, in a syndication deal, that's kind of baked into the deal. I mean, typically you're going to have a limited partnership structure with a general partner that's usually the promoter that's setting up the deal, and then investors coming in as limited partners. And then you're going to have underlying real estate, which could be directly in the limited partnership or could be in LLCs in turn held by the limited partnership. So, by the nature of that structure, you've already isolated the real estate. It's very hard for one limited partner to come in and reach the underlying asset. If you also structure this up the chain to your own holding company and your own, if applicable, asset protection trust, then you really almost eliminated the possibility that someone can reach the asset directly.
So once somebody has done a syndication, created a PPM, and all of the syndication documents, at that point, can they still reach out to you? Does it make sense to continue or extend the protection ability of the things that you can offer? Is that something at that point somebody's already handled it? Tell me more about that.
Yeah, so those are two totally different things. So the PPM, the offering documents, the limited partnership that is the underlying deal, that's one thing. And I don't do that, and you want an attorney that understands that and that is in that area to be doing that work for you. So if you've already done that, that's good. You want that. But what I do is over here, and it's taking your interest in that, whether it's the carry that you're going to get as the GP, whether you're also participating as a limited partner, whatever it is, it's taking your interest and saying, okay, now where do we place that? That's the part that I get involved. So yeah, if you've already done that part, that's great. You should still call me because we need to now discuss how you're going to hold your personal part of any structures that you have.
Tell me about that from the limited partner perspective. I'm curious. If I'm a limited partner and I invest with some company and then I'm completely passive and hands off,
Yeah.
but I have some level of concern, what if these guys take off with my money, or how can I protect myself if something strange happens and I'm just being cautious? Are you able to help that person protect themselves or file suit against a sponsor for things that they do that they may be held liable for?
Right. Okay. So now you went the other direction, right? So
Yeah,
you're saying I'm an investor,
yeah.
and I want to make sure I don't get taken from an investment. So no, that's not me. I'm going the other direction. If you're an investor and you want to make sure you don't get your part taken from somebody who's coming after you. If you're the organizer, I'm the one that you want to call to help protect from your investors. If they decide, hey, I thought I was going to make 15% of this deal, I only made 8%, I want to sue. That's where I come in. So, I'm very, very clearly, my mandate is to protect my clients' assets from those risks.
Okay, and then as a limited partner, if I come in, I put my money with a sponsor, and then can you help me protect from the residents on the property and from other things that may happen on that property to make sure that my money is protected?
Okay, so on the property you've invested in, there's no need. You're a limited partner. There's nothing more they can go after you for if you're only a limited partner. That's the advantage of being a limited partner. You have no additional liability. You cannot protect the investment that you made. So if you put $100,000 in and the property was improperly insured and didn't have the proper fire protection and burns down and now is worthless and your $100,000 is gone, that's the risk that you take. So that's not protectable. That's why you want to be investing with good GPs that have done this, have a great track record. You don't want to be investing with people who don't know what they're doing. So that part of it, that's not asset protection. That's investment savvy, and you need to have that. Asset protection is if you invest as in a limited partnership and then you go out and get in a car accident and you happen to hit a bus full of brain surgeons and there's $25 million of liability and you have $500,000 of auto insurance. Now that's where I'm protecting you. So you've got a bunch of LP investments. They're worth $2 million or they're worth 500,000, whatever they're worth. And you have some outside liability that is threatening those as an asset. That's where what I do comes into play.
So what are some of the creative techniques, strategies, models, vehicles that you use to protect the assets?
So that's a great question. So the first thing is we would take your underlying assets and we would consolidate them into a holding company. The holding company concept is good for lots of reasons. It consolidates your tax reporting. So you're really going to have one tax return that you're doing all your accounting on for all of your assets. So let's say you have a stock brokerage account with some cash in it and you're making interest income and dividend income. And then you have some various limited partnership investments that you're also making passive income on. And let's say you're also a general partner in a couple of deals that you're going to make some carry on. All those are assets which can be consolidated into your personal holding company. Your personal holding company is where you're going to report all that income, but it's also your first layer of asset protection because you have a limitation of a creditor's ability to get into that holding company because we use a limited partnership. So I'll side note here on limited partnerships. Limited partnerships are one of my favorite legal tools because they have a limitation on what a creditor can do to get into them. So if you have a limited partnership and you're a limited partner, so let's say you invest in a deal and then you get sued and there's a judgment out there against you. That judgment creditor takes it to this limited partnership that you invested in and says, hey, I want Ruben's 12% interest in this that's worth $250,000. The general partner is just going to say, sorry, you can't get into these assets. If we make a distribution, you can deal with Ruben on that and the courts on that, but you have no right to come in here and demand anything. You can't foreclose under the underlying assets. You can't do anything. And you definitely cannot take his position as a limited partner. You are limited to an assignment of his interest. And what that assignment is called is a charging order. So that creditor can get a charging order against your interest, but they can't come in and take your interest, and they definitely can't come in and take the underlying assets. So that's the huge advantage of being in limited partnerships. Well, because of those advantages, we also use a limited partnership as your personal holding company. Why not have those same advantages for your personal assets? So we create a limited partnership to serve as your holding company for all your personal assets, other limited partnership interests, cash, investments, stocks and bonds, LLCs that hold rental real estate that you might own, whatever it may be, you have a holding company. And then if your assets are sufficient, we look at a third tool called an asset protection trust. And that can own that holding company and really provide advanced protection for all of your assets. And that trust is very specifically designed. It's a domestic trust, but it's also a foreign trust. And again, it depends on the level of your assets, but if appropriate, it can protect you in a way that nothing else really can.
So then for people who have invested into these deals with cash or with
Yep.
an IRA, if they haven't done it with a holding company, can they protect the self-retirement account money that way as well? Or is it just cash investments? Do you have to invest in the holdings company first and then take money from the holding companies and invest into a deal? Or can you already have invested in cash and then move it into a holding company that way?
So let's talk about the IRA or the qualified plan money first. Qualified plan money, for the most part, is protected already. So if you have money in your qualified plan and you want to invest in a limited partnership deal, you don't need a holding company for that. You just go ahead and invest straight into the deals. Just like you'd open a brokerage account for that holding company and invest directly in the brokerage account or for that IRA. So if it's an IRA, a 401k, a qualified plan, any of that stuff, then you don't need the holding company because that already has protection. If it's outside of qualified plans, then you need the holding company. And so if you've already invested in limited partnership deals and you call me and then we decide it's appropriate to add a holding company, we can switch the investment into the holding company later. If you haven't yet invested in deals, then yeah, you'd want to get the holding company first and then use the holding company to invest in the deal.
Fascinating. Okay, cool, man. How did you learn all of this stuff? Like, I know you're from Switzerland, right? But you're a self-proclaimed gringo. So tell me about your background, how you learned all about this.
Yeah, so my dad is an attorney, and he was in Europe after law school, and I was born. So I was born in Switzerland, but I was born to American parents, and they quickly moved back here. And how I got involved in asset protection is because my dad. And way back in the 80s, before real estate syndication was really a big thing like it is today, he was doing real estate syndication.
Hmm.
And if you remember, or if you heard about the savings and loan crisis that occurred in the mid 80s, particularly in Arizona, he was right in the middle of all that. And so he had done a lot of syndications with his clients, many of whom are doctors and other people that were really trying to take advantage of a lot of the tax benefits before the Tax Act of 1986. There was lots more benefits than there are today. And when that S&L crisis hit, a lot of those investors had their own financial crisis. And their creditors came along and came to him as the general partner and said, hey, we want those underlying assets. And as we explained before, he was able to say, sorry, can't get them. And he realized as an attorney, oh my God, that was an amazing asset protection tool. And then from there, he actually started creating asset protection structures using the same limited partnership concept, and then eventually researching and adding the offshore asset protection trust. So it was very organic. He learned it from real practical experience in the field. And then, of course, he taught it to me, and I've been doing it for 22 years. And, this is all I do is asset protection.
What are some of the main flaws or problems or hiccups that general partners have that you see where you can't protect them, or things that they are doing incorrectly?
Well, okay. So first of all, understanding, and you'd be surprised how often I see this, because they are actually getting this advice from time to time. Understanding that you have to follow the rules around taking anybody's money, and this is getting stricter and stricter. So the days of just getting a bunch of people together and going, "Hey, let's get into a limited partnership, and we'll all put money in, and then we'll do this deal." Those days should be over, because if you're still doing that without a PPM, without a full disclosure document, without all the things that you can rely on to show that they understood the risks they were taking, that they knew that they were not in control of the asset, that you were in control, that you would be self-performing on some of the work, all of those things have to be disclosed. So the number one mistake I see, especially for beginners, is not getting that documentation right. Just kind of skipping that step, and they'll set up a limited partnership and they'll start taking people's money. From there, the other thing is just making sure you don't overpromise. And there's a little bit of a a balance there, because of course you want people to invest. And so, yes, you want to tell them, hey, I believe we can get a 12% return on your money here in 2 years. But at the same time, you don't want to imply anything that you're promising any specific returns. And again, where people get in trouble is not in the beginning and not when the deals go as planned. It's when the deals go not as planned, when they fall apart, when something happens. And everything's been rosy for the last 10 years. I want everybody to realize it's all been good for the last 10 years. But I was around in 2008 when these things fell apart and when real estate crashed. And believe me, none of your pro forma numbers are going to apply if we have another 2008. Even if we have something a fraction that bad, things are going to change dramatically. So you need to be really clear with your investors that they're taking a risk. They are taking a very real risk investing their money, and that's why you're shooting for the returns you're shooting for, because they're taking that commensurate risk.
What are some of the other things that they've done? What is, like, any examples really stick out as like, man, this guy really just did something wrong?
Well, yeah, I mean, certainly misrepresenting anything is a huge no-no. Not being clear, exceeding the mandate of what you started with. So you get in there and you're going to do one multifamily deal with 8 units, and all of a sudden, it parlays into something much bigger or something all different altogether. I mean, the bottom line is if you do it right I'll tell you another big one is that people do a deal, it goes well, and they just roll right into another deal and it goes well. And next thing you know, they've got 5 or 6 deals, but they never separated the legal structures. So they're all in that original legal structure. And then that second deal that they did, somebody comes back and says, oh, we've got some sinking, the foundation is cracking, and now you have this huge liability and it's impacting your new deals because you put it in the same legal structure as the first one. So it's very important to segregate each deal and not just throw them in together.
Yeah, that's phenomenal advice.
Yeah.
Okay, cool. What about when it comes to joint venture versus syndication? Anything that you see there?
Well, give me a detailed description of what you mean by joint venture.
When you're talking about syndication, there's some things that you can do as a GP to protect yourself from the passive people that may have a problem with you. But now let's go into, and I know that people are doing this on a big scale. I used to do it on 4plexes, 12plexes. Take a couple of partners, they would invest the cash. We would provide the handling of everything, the finding, the acquiring, the everything, rehabilitating it, tenant occupying it, putting it back on the market. And they would do some stuff like maybe, walk the property, make some decisions on some very generic things. But in those cases, do you see an opportunity where you can get sued by one of your partners?
Yeah,
Does it
yeah. I
does
mean
it make sense to get your services for that?
yeah. I mean
Especially if you're
that might be the single greatest threat that you have is partnership deals where everybody's going, oh, I'll do this, you do that. I much prefer a syndication deal where there's real clear separation between the roles. I'm an investor or I'm a GP, but JV deals or partnership deals where people are going to go in and you put up the money, I'll do all the labor, and next thing you know, there's not real clarity, or the deal goes bad, or the deal goes extra good, and all of a sudden the split doesn't seem fair. All those things are reasons to sue. So I would say if you're going to do JV deals or partnership deals, you have to be even more careful, and you have to outline, I mean, written outline of exactly what the roles and duties are, because the other risk is somebody's not performing. What do you do then? They're not performing. They either couldn't come up with the additional cash if they're the money partner, or they're failing in their role as the manager. How do you get them out? Have you planned for that contingency? And what happens to their sweat equity interest when they get booted because they can't perform on the operations? So it's very, very, very important to have all that covered. And yeah, if you're going to do that, you definitely want asset protection. You definitely want to protect yourself in case something does fall apart.
Yeah, I would say back during the crash, I probably could have used those services. I mean, there was probably a lot of risk in the way that we were structuring, because we would just take like three or four people and put them all into. We'd all own an LLC together, and it was
Yeah.
just a very generic LLC with
Yeah.
ownership rights, and
No
there's no
clarity
no
and
protection, no clarity, none of
yeah.
that. Just like boom, 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 the standard partnership agreement with you know it was probably pretty risky, but I'm glad we didn't have any major problems. But for
Yeah. Yeah.
people that are
Lucky.
doing that, maybe even on a high scale, because I know that I speak to a lot of syndicators that are doing 100+ units on a regular basis, and
Mhm.
occasionally I run into somebody that says, "Well, yeah, I actually prefer doing joint venture on these 100 unit plus, which is a lot more zeros at the end of the deal." So those guys probably even need more
Yeah.
protection than what I do. So what can you offer for those guys? What are some of the things that you may recommend for that individual?
Yeah. I mean, if you're out there doing those deals and you have interest, the best thing you can do is you can sit with me and we can talk about your entire structure. I mean, what I do is I look at everything first. I get it all on the table. I understand what it is that you're doing, what's an asset, what's not an asset, where your risk really lies, what kind of risk you're taking. And then step one is to help you identify where maybe you're taking risk unnecessarily, where maybe we can restructure some of the way you're holding things or doing things to reduce the risk. Step two is, okay, once we've reduced the risk to the greatest extent we can, how do we then take the assets segregate them from each other. So we use the holding company concept, but then we also use underlying LLCs. And I mean, Ruben, it is very specific to each person. But a typical structure might look like a holding company, which is controlled and managed by the client, and then an asset protection trust, which owns the majority interest in the holding company, and then the holding company holding underlying deals, either limited partnership interests or LLCs, which control general partnership interests, et cetera. And we do a lot of segregating under there to make sure that everything is protected from each other. We're not throwing everything in one big risk bucket. In some cases, we do more than one holding company. I've got some clients that have kind of a risky side of their business and then a fairly safe side of their business. In that case, we actually do two separate structures and still have one asset protection trust on top of it. But what I can tell you is that the best thing they can do is spend 40 minutes with me on the phone and understanding how they can actually structure things. And a lot of times they have a lot of stuff kind of half set up. They have some LLCs. They might have an S corp for management, and we'll work with that. I'll look at it. I don't throw away a lot of things unless they're really unnecessary. I try to use structures that are already in place and integrate them into whatever we need to make sure that it's actually protected. But yeah, the best thing is to talk and to understand.
Tell us a little bit about the trust. When does it make sense to use a trust? What can a trust do that a company can't do? The differences between a company holding property and a trust holding property.
Right.
Walk us along that.
Okay, so it's a really good question because companies, LLCs, and so forth, they're almost always the best choice to hold the underlying asset. But they are limited because they remain domestic. They're always subject to U.S. jurisdiction. What a trust can do that a company or an LLC cannot do is select a jurisdiction and then enforce that selection of the jurisdiction. So in the case of the bridge trust, which is really the best tool, we have the capacity, if we ever have a real challenge, a real threat to the asset. So let's say we've done this entire structure and one of the deals that my client is in blows up spectacularly. And he's a general partner, and it looks like there's going to be massive amounts of risk. And let's say he was even a personal guarantor on the underlying debt related to the real estate. And it's going to blow up in spectacular fashion. And so that asset we can count as gone. The goal is then how do we protect all the other assets that he has? That's where the bridge trust comes in. Because without the bridge trust, if you just rely on the corporate structure, what happens is a judge can get it all into their courtroom in front of them and say, okay, well, great. This is all one pie for me. And the creditors, whether it's limited partners or banks, whomever, can go and try to reach those other assets, and in many cases successfully reach the other assets because it's still all domestic. With a trust, we can remove it. We can make it non-domestic. So all of a sudden the trust is out of the Cook Islands, and the Cook Islands doesn't recognize any U.S. judgments, U.S. court orders, any jurisdiction other than their own. And any legal action that happens here is just not worth anything in the Cook Islands. That's a game changer. And certainly kind of the line we draw of when you need to start considering that, it's actually just about $1 million of assets that are protectable. In other words, assets that are not already protected in some fashion, like they're not already in your qualified plan, or they're not already an exempt homestead or something like that. But if you have $1 million of assets, whether it's cash, limited partnership investments, whatever it is, then that's when we start looking at the bridge trust as a piece of your overall plan.
Interesting. Is the trust similar to an LLC where you can do it in different states, specific to different states?
Yeah, so a trust is in that sense similar. You have different jurisdictions which allow for the creation of these trusts. So there's about 24 jurisdictions outside of the U.S. that specifically allow for the creation of an asset protection trust. And then there's 16 U.S. jurisdictions, states, that also allow for that. So we use a combination of both.
Fascinating. And then for the companies, when are specific times that you want to build the company or LLC out of Arizona if you're buying in Arizona, for example?
It's a good question because there's a lot of people that go, oh, they read about a Nevada company or a Nevada LLC, and they think, oh, I want to use that, all these benefits, and then they go and they buy a rental property in Arizona. Well, guess what? When you get sued by a tenant in Arizona, the judge in Arizona is going to look at it, and you say, oh, it's a Nevada LLC, you have to apply Nevada law. The judge is going to laugh at you and go, sorry, buddy, this is holding an Arizona piece of property. It's doing business in Arizona. Guess what law that judge is going to apply? Arizona law. So there's not any big advantage to have an LLC holding a piece of property in a state other than where the property is located. There's really not. And a lot of people, I think, who like to sell Wyoming LLCs or Nevada
Uh-huh.
LLCs kind of make it seem like there is, but they're misrepresenting the way it really works in real time. If you're holding an asset in Arizona, you might as well use an Arizona LLC.
Yeah, I've heard some complicated structures from some syndication teams that are using Delaware companies for the, I think, limited partner, or Wyoming for the limited partner, and then like a property or an LLC state specific to wherever the asset is for the general
Right.
partnership. And I
Yeah.
know I was like, I don't understand why they do that, or if there's really any benefit. But they're selling themselves like they're experienced, right? So you're saying
Well, I mean,
that.
there can be benefits to using an out of state company as long as it's not holding an in-state asset. So if you're using an out-of-state company to, let's say, serve as your holding company for your general partnership interest in a limited partnership that is based in Arizona, and doing an Arizona deal, that might be appropriate because now you've diversified the jurisdiction, and as the general partner holding your share out of a Wyoming LLC, that's okay. But if you just try to do everything outside of your home jurisdiction just for the sake of it, just because you think somehow it magically protects you, it just doesn't work like that. Yeah.
Okay, give the audience some places where they can reach out to you. I know that I went on your Facebook. I've known very few lawyers that are on Facebook, and you are no exception. You have account, but it's not active. Why
Yeah,
do you guys do
Facebook is
that?
not the place to reach me.
So where do people actually find you?
Yeah, I mean, the best place is my website, which is just lodmell.com, LODMELL.com. There's tons of information, and I mean a lot of information. There's a video series on there called The Key Concepts of Asset Protection. It's 3-minute videos. There's about 15 of them, and it really walks through what makes asset protection work. So I would really encourage everyone to watch that. If you're listening to this and you know already that this applies to you and you want to get on the phone with me and talk about it, that's absolutely the best way. And I would just call my office, 602-230-2014, and just make an appointment. I'm happy to talk to you. I won't charge you for that initial appointment, and we can kind of walk through it, and I can give you an idea of if asset protection is something you should be looking at or not.
Very
Uh,
cool. I think I'll probably hit you up on that. I'd like to.
Yeah, you're welcome to. Yeah. And then
Any
anybody's welcome to email me. My email is just my name, Doug@lodmell.com.
Perfect.
Yeah.
And then any last words of advice for the syndicator, or either experienced or somewhat newer?
I mean, the best thing you can do is get all the information and understand what a proper structure looks like, even if it's not yet applicable to you. So the biggest mistake I see people make is going, I'm not ready for that, so I'm not even going to learn about it. That's a mistake. Learn about it even if you're not ready for it, so that you'll be able to self-identify when you are ready for it. When I look at property, I always look at the most expensive stuff and work my way backward, because then I understand. Most people do it the opposite. They start at their budget and then they maybe stretch a little bit, but you'd be shocked. It's much more effective to start at the top and work down to where you want to be than start at the bottom and work up. You get a different level of advice. You get a different level of inputs, and it's no different with this. Start with the best. Start with where you want to be, and work your way back to where you are today.
Man, fascinating conversation. I'm super excited that I had the opportunity to interview you. I didn't know where our conversation was going to go, but there's
Yeah.
definitely a lot of gold nuggets in there. So I hope the audience can capitalize on that information that you provided. Thanks again so much for coming on the show. Hopefully, I'll be in contact with you soon, and we can go have a coffee, or I can stop by the office and talk a little bit further.
Yeah.
about asset protection. There's some personal stuff separate from my business that I also need to go into detail with. So
Okay.
great.
Happy to do it.
All right,
Yeah.
cool. Well, enjoy the rest of your day.
All right. You too, Ruben. My pleasure.
All right, take care.
You definitely want asset protection.